one of the biggest things that I see business buyers, especially first-time small business buyers, struggle with is sort of getting oriented in terms of the quality of the business that they're trying to acquire or evaluating acquiring, and the purchase price, that they're willing to pay or have to pay or whatever it is. And so today I came up with the quality price matrix, and we're going to dive into the different categories and hopefully share how I think about some of these things that will hopefully help you. My name's Walker Dybel. I am the Wall Street Journal bestselling author of Buy Then Build and creator of the Elite Acquisition Accelerator Acquisition Lab. Okay, so a lot of times, especially as we first start to navigate the private capital markets, we see like all these like subjective valuations, and every business is different, and it's kind of like dating in that sense. It's kind of like, all right, what do I think about this, in this case, business, and where would I sort of put them in terms of willingness to hang out, and willingness to sort of spend money and time on and whatever, right? So this is kind of the quality price matrix. Price is obviously much more complicated. I'm just making it simple, okay? Because it's complicated because of the terms involved. Is there seller notes? Is there personal guarantees? Am I having to pay for working capital or including working capital? Is it based off of adjusted EBITDA or SDE or what other earnings number or whatever it is? So I'm just calling it purchase price, okay? Just assume for this example, cash at close, whatever the purchase price is. Quality, okay, is a bit subjective. We'll get into that. But this is the sort of category here in terms of like, is it high quality or low quality deal that I'm looking at, right? So, you can see there's sort of four areas here. And, in the lower left, over here, this is sort of a low price deal, but it's also kind of a lower quality deal, right? And so you could categorize this as like a dog, right? It's a low quality deal that is probably priced low because no one wants to buy it. Which, by the way, there's secret opportunity in here, and these are usually called turnarounds. But over here, the quality and price. So the price over here is actually really high. Okay, you've got a high price, but the quality of this deal is kind of low. All right. This is usually a proud seller who maybe needs a certain amount of money in order to retire properly, and they don't really care if they sell their business or not. It's just that they need to hit a certain number in order for it to make sense for them, and they haven't gotten patient yet, okay? There's no, death, disease, drugs, disability, divorce, whatever the D's are. Up here we have, this is a high quality deal, okay? Let me switch colors. Okay, high quality deal, all right, Q plus, and this is also a high price deal, okay, P plus. A lot of people argue that this is where brokers live, okay? I generally disagree with that. However, this is the concept would be usually you get a high price because maybe there's a bunch of different buyers who like this opportunity, or institutional capital that's all kind of going towards one deal. They can pay more. It's still a low price to them. They need to deploy, their investors' capital, and they can still get a good internal rate of return, something like that. Something where, extra, but whatever, you've got a high price, high quality deal. And then over here, just to use black one last time, I'll say that this is going to be a high quality deal, right? High quality and low price. Okay, boom. This is what you want, isn't it? This is what everyone's trying to get. Walker, how do I get that high quality, low price deal? All right, now the thing that's interesting though is that as you look at this, there's actually this sort of, spot right in the middle, all right? This part right here, okay? And we'll go ahead and call this, there's this box kind of right in the middle of this thing, right? And this, like my box solid, this is going to be called fair market value, okay? So this is where you get that sort of equilibrium in terms of, maybe market comps and, the quality of the deal, right? Like there's going to be this kind of like value range of any business that sort of is going to hover sort of in the middle here, right? Perhaps for a different video, this is where I believe most brokers actually try to live. Most, okay? For what it's worth. Now, and let me dive into that just for a second. It's because this is a thin market, ladies and gentlemen. This isn't something where, every business that's out there is unique in its own fashion. Usually they need a buyer within a certain square mileage radius. Usually they've got, certain things that they're trying to protect or whatever. And the odds of these small businesses getting multiple offers is actually quite rare. There's not usually multiple offers at the same time. It happens in different segments of the market for different reasons, but the thing is that when someone hires a broker, even if they're trying to get the highest price, for their business, the broker is still trying to value it in the fair market value range. And the reason is because brokers can't take on clients that don't sell. And so a lot of times, if you get this high quality, high price deal, a broker won't take that on unless they know they have multiple, usually institutional buyers in order to get that done, right? Again, that was a side note, forgive me. The thing is like, I want to talk about high quality, low price, but first I want to talk about what is quality, okay? Because this will back us into it. Quality is one of those things where there's a few things. There's intrinsic quality, market quality, subjective quality, and growth versus stability, okay? Let's break those down. First is intrinsic value of the business, okay? These are the types of things that I usually look for businesses where clear intrinsic values are missing, okay, which is weird. But in the acquisition lab, we have something called the 6 elements that we use to evaluate deals and figure out, where are they in terms of like this intrinsic value and where would it fit in this graph. Ultimately, I'll just leave it at this. Like a lot of businesses will tell you what the growth opportunity is, what the earnings opportunity is. And if there's something that's very clearly lacking in the industry, okay, including in the company you're looking at, that's going to drive a lower price, but actually higher quality to you, because if you can build that intrinsic quality in the asset that you're building, later you can sell it for more money, right? You're increasing the thing that drives the intrinsic value of a business, okay? Second is sort of the market quality. I'm going to go so far as to say that this is usually included or implied. If there's a list price, it's usually in there already. It's built in. Let me give you a couple examples. If you're looking at like local, B2B, tech support companies, like private equities just sort of moved into them. There's a lot of demand for these types of businesses, and they tend to sell it at higher multiples than like same exact companies, in different industries, right? Another example might be anything in the pet space right now is just like selling for, higher valuations than similar companies of similar size, product diversification, all the rest of it, growth rates, because of the fact that they're in this pet industry and there's a lot of consumer interest in it, right? I brokered a deal about a year ago that was a mushroom supplement business, and it was one of these where we got 13 offers or whatever, and I was already positioning it up here, so it ended up sort of selling at a higher price, and it's a high quality business, but to the buyer it was actually a low priced business because of what he could do with it and because of the demand in that space. So that's the sort of like market quality, right? I mean, if you have let's just pick on customer concentration. If you have a company with 90% customer concentration, that's gonna fall somewhere down here. Like most people are just gonna consider that low quality, right? If you can actually get in there and get the specialized knowledge to figure out that customer is not a risk, okay, it all of a sudden is going to become a high quality deal at a low price to you, right? So these are the kind of tricks. It's sort of like, what's the intrinsic value of the company? What's lacking in terms of building the intrinsic value? What's the market quality of the company? And is it sort of priced into the deal? Next is going to be the subjective quality. And, we're hinting on this because it's one of these where, in buy then build, I talk a lot about the prep funnel, right? It's everything that buyers were getting wrong when they were failing. It's everything that brokers, get wrong, and how you can sort of engineer success in your search from the beginning. I believe that the trick to you finding a business that is low priced and high quality is actually by finding a business that's priced at fair market value more often than not, and finding something that's high quality to you in a subjective sense, okay? A lot of people are going to use first order thinking and tell you, listen, I want you to find off-market deals because that's where these things happen. right? And that's fine. Go spend a whole bunch of time doing that. You might luck out, especially if you have a really long time horizon. That's a great strategy, right? But if you're like, look, I'm looking to buy a business in the next 6 months, for example, okay? I really encourage brokerage. I really encourage you to reach out to brokers. I do it in buy then build. I explain why. But the point is that you're looking for that business that's priced at fair market value, that you can either find the thing that no one else is seeing, or bring something to the table that can make it special for you. Okay, make it a good opportunity for you. That's really the core trick. Okay, that we teach in buy then build. And then you've got growth versus stability. So a lot of times the market will treat growth as, they'll really reward growth, right? Like it's actually like a fundamental driver of value in the business, is how fast is that business growing. Other people sort of look at that and say like, okay, this could be high priced, because do I really think that growth is going to continue, right? There's another video that goes through the risk opportunity heuristic, where we talk about trying to balance out, how fast can I get my money back, right? When I'm looking at any kind of deal, to get that balance right. That's part of it, right? And so growth is sort of forcing the market to pay higher valuation for the company, because you can get that money back in the same period of time. That's the theory behind it. Other people just want stable businesses. They want no growth. They want to be bored. They want to buy something boring. They want to just buy something that will pay down the equity, build up your equity, pay down the debt. And they don't really want to buy then build. They want to sort of buy then chill. There's nothing wrong with that. It's a different asset class. So if you're looking for stability, in theory, those things are priced only slightly higher than like a high growth, than an average business, because they're sort of selling the stability, like, hey, this is a cash cow. But it's one of those things where you have to figure out, what's more important to you. Are you willing to pay a little bit more for a super stable business, or are you looking for something that you can build, double, and make millions of dollars in sort of a faster time frame, because you're able to grow that business, right? Again, paying attention to the fundamentals, of course, but looking for something with a little bit more upside. Listen, if you are looking to buy a business in the next 6 to 24 months, please check out the Acquisition Lab. It is the elite acquisition accelerator. We've got a highly vetted community. We've got world-class education, diamond method coaching, and a suite of tools, resources, and supplier network to get you to your goal faster. After I wrote Buy Then Build, I just, I was getting 1 to 2 dozen intros a week of people looking to buy companies. And I spent a lot of time saying, okay, look, how do we get a vetted group of people in a room and, focus on results and, build what they need around and get them to where it is they're trying to go faster. Check out Acquisition Lab, and we'll see you on the inside. Thanks.